Welcome back to FT Markets. German Bunds, 10-year debt issued by the German government, are meant to be dull and boring, but lately they've been anything but. Large-scale buying by the European Central Bank have sent prices soaring, and Germany's borrowing costs have plummeted almost to zero. With me to discuss what this means for global finance is Zoeb Sachee, who is the head of European government bond trading at Citigroup. Zoeb, welcome to the Financial Times. If you look at our first chart, you can see exactly how dramatic an impact QE has had on German 10-year bond yields so far. Tell me, is this just ECB buying that's sending yields lower, and are they going to go below zero?
I think the ECB buying has quite a lot to do with it, but I don't think it's the only factor that explains why yields are where they are. I think the reality is that the supply picture in Germany is very favorable for yields to go lower. And also, and this has been the case for a while, there's a lot of investor demand for structural reasons, for regulatory reasons, to buy bonds.
To buy safe assets.
To buy safe assets.
Okay, is it going to go below zero? We're very close. We're just above that zero line at the moment.
I mean, zero doesn't really, in our view, represent a floor anymore. A more reasonable floor is minus 20 basis points, which happens to be the ECB's...
The minimum that they'll buy at, yeah.
That's right, exactly. And also, a lot of the European bond market, government bond market, now trades at negative yield. So investors are getting more comfortable with the idea, of yields going negative, and they're not put off by it.
Okay, now, but if quantitative easing is meant to stimulate economies, boost inflation and growth, now usually bond yields should rise on that. So presumably at some point, if QE works, yields should go back up again.
They should, but increasingly we're seeing that the traditional movers of bond markets, i.e. growth, a pickup in inflation expectations, and a pickup in expected interest rates, are not so much the drivers of bond markets anymore. It's more, I think, the perception of scarcity and supply shortages.
You've illustrated that very nicely in this second chart that you brought along. It's slightly complicated, but what you're basically showing here is supply, how much the government is issuing to fund its daily operations, and how much has been redeemed. And we get what's crucial is the net line, isn't it?
That's
what's
right.
This showing?
That's right. So what this is showing, if you look at the black line in 2014 versus 2015 and 2016, what it tells you is that the effective net demand for bonds is going to be greater than the actual amount supplied. The supply picture over these 3 years is likely to be broadly similar in terms of gross supply, the actual amount of bonds issued. But if you factor in the redemptions and the coupon payments, and of course, what the orange section shows, which is the ECB purchases, you get a result for 2015 and 2016 that's dramatically different to last year.
That explains why the prices are going up and the yields are going down.
Absolutely.
What's interesting, although, what we've seen in the last week or so is actually, because rates have been so low, you just need a small movement, and proportionately, it's a very big jumps that you're getting in German bond markets, and some people are joking about flash crashes in German bonds and so on. Do these levels of volatility at such low interest rates worry you as a trader?
At the moment, I don't think so. I mean, I think what you're seeing, generally speaking, and of course some days can prove to be the exception, is that there's a sort of a self-fulfilling reluctance from investors to sell aggressively to the ECB. And I think that's fueled by the fact that there's been such strong performance in German assets. And as I said, people are no longer put off by the prospect of zero yields and negative yields.
You say, for now, we're not seeing big problems. Do you worry that these sorts of shortages that you show are going to create sort of liquidity crunches, sudden sharp movements in bond prices in months to come?
I think what the ECB are going to do over the next 18 months or so is now known. It's completely certain, and therefore I think it's somewhat priced in. What is less known is the willingness of investors to sell. So I think that could be the catalyst for significant and abrupt moves. And just as you're having self-fulfilling reluctance to sell, that might change, and might change abruptly.
And of course this matters hugely for the rest of the world, because German bonds provide a benchmark for other borrowing costs across markets.
Yes, that's right. They do. So obviously an impact on the German market is going to be quite important for the valuations of other Eurozone bond markets as well.
A final quick question. Can't have a video on Eurozone bonds without talking about Greece. Some people think that actually one reason why bund yields have been falling is because a rush for safe assets. You mentioned highest quality assets. Do you think Greece is an explanation for why German bund yields have come down and therefore could go back up again if Greece is resolved?
I think it's part of the explanation, and it's definitely the case that bunds are seen as a safe haven asset and a hedge against a very negative outcome in Greece and in the Eurozone in general. However, I think the possible contagion from Greece is quite limited, and I think this is also reflected in the fact that the movements in German and other peripheral markets tend to be much lower as a result of the events that are happening in Greece.
So we're going to have to stop there. Thank you very much. So Greece having some impact there, but QE buying, the big impact on German bund yields may well send them negative.